Good afternoon, everyone. Welcome to what is hopefully the first of a series in our partner webinar series today. Thanks for joining us. Most of y'all know me. I'm Mike Tarrant, founder CEO of Tarrant Financial here in Atlanta, Georgia. And we're happy to bring a webinar to everyone today and hopefully give you some good information to help you with your investments and navigating these challenging times. So today's title is Remaining Calm, Cool, and Invested When the Markets Are Not. And our guest speaker today will be Greg Davis, a senior regional consultant with MFS Funds. And just a couple of words before we turn everything over to Greg today. You probably already know we launched our new firm name, Tarrant Financial, earlier this year. Hopefully y'all like the new name, the new look. Please feel free to check out our new website at tarrantfinancial.com to get a better idea of the mission behind our firm and how we're trying to help our clients achieve their financial goals and financial security. MFS International Diversification is one of the core funds in our Tarrant Financial Alpha portfolios. It's our primary international holding. And as such, we've been working with Greg for 20 years now as our local consultant with MFS Funds. And as such, Greg brings a lot of great information to us about our mutual funds and our portfolios, investing in financial planning, strategies that we can bring to you as well, and good information. And so we're very happy to have Greg on board with us today. A couple of housekeeping items. We are recording the session, and we will work with Greg in compliance later to confirm distribution of the recording if we're allowed to do that. And we will be handling Q&A in the chat today, which you should see toward the bottom of your screen. And Charlie Curry will be monitoring that for us as well. And we'll attempt to answer questions toward the end of our presentation today. We are good until 12:35. And Greg, we're going to turn that over to you for kind of your presentation here today, and maybe some time permitting, little updates on current events, MFS's thinking on the current banking issues, inflation, Fed policy, et cetera. I know that's on everybody's mind today, so we probably ought to spend a few minutes chatting about that too. So, Greg, thank you very much. We're going to turn that over to you, sir.
Awesome. Thank you so much for having me. And I know that I'll share the screen real quick. Tell me when you can see that title page.
Looks like we're seeing about half of it.
Yeah, well, so the way it works is we do a title page only so that we can do the book format. But you've picked a good title when, Mike, you almost slipped up and said calm, cool, and collected, right?
Yes,
we took the last word of a very, very popular phrase and we replaced it with what everybody needs to be, which is invested. But I will say, this is my 25th year doing this. And I've come to, different conclusions throughout the journey. I had different conclusions that I came to after 0102. And then I had different conclusions that I came to after 2008, and obviously different conclusions after the run after that, and then the COVID, kind of mix up there. And when you put it all in the blender, I do have to say that I feel awful for the average American investor. I feel awful in that we have made it so hard to remain calm, cool, and invested. It seems like there is so much noise and so many things, and what used to be, when there were only 3 news channels, just as much stuff going on, by the way. But if you didn't know about it, it kind of didn't kill you. And you were able to stay the course, I think, a lot easier than we are today. I think the major culprit is this thing right here. Never mind the bigger version of that's we'll call the iPad, and then the really big version, which is the thing hanging in your den, the big flat screen TV. And then you add to that what's on this, which is the Twitter and the Instagram and the Facebook, and it's just, you're being bombarded with, maybe I'm being a little flippant, but you're being bombarded with nonsense that has nothing to do with what we're trying to do, but you're constantly being hit over the head with it. And so what I feel, even 20 years ago, people kept things in their own lane. So you had your views on maybe the economy, which were different than your views on maybe what's going on in DC, which are different than your views on what's going on international relations wise, which was very different than what you were thinking about your portfolio. Well, now I feel like it's just one big giant patchwork quilt, and you feel a certain way about things, and it now covers everything. I still meet with people who say I haven't invested after the election. Okay, which election? Well, the 16 one. Okay, well, that was a long time ago. And then I had people who said I'm not going to invest after the 21 because they didn't like how that went. And I have people that say, what the hell are we doing with the tanks in Ukraine? I don't feel comfortable investing. It's just this one big emotional roller coaster that has people doing the wrong thing. And how do I know that? It's the data. So, what was the most popular asset class last year? It was CDs. Man, there was a sale of anywhere from 10 to 20% at Publix, and none of us bought any chicken. We went and hid in the parking lot, and we want to wait till the sale ends, meaning things come back, and then we'll feel more comfortable getting in. I the reason why I feel bad is because it's not your fault that you're confused. It's not your fault that things seem like a gong show. It's not your fault whether you're Rachel at 9 or Tucker at 8 or Hannity at 9. It doesn't matter what you like. It doesn't matter how you believe in certain things, because I have certain beliefs as an American citizen, as a father of 4, and I have concerns, but I've never once looked at those concerns and then opened up my retirement plan statement and said, "Hey, let's make a decision on this because of that." So today, and I can make comments about stocks, about bonds, about international, about emerging market. I can do all that, but I got to be honest with you, I don't think it matters unless you're investing for the 5-month period. Which, if you are, I pray to God that you're not in the market, right? So for the short-term needs, right? You want to buy a boat this Memorial Day weekend. I hope that's in a sneaker box under the bed or in a CD or something like that. But if we're 65 years old and we're married and we're retiring or just retired or whatever, you go to any actuarial table at any insurance company, and they're going to tell you that one of you, sorry guys, it's her, is going to live till 93. So yeah, you might be 65 and yeah, you might be retired, but 65 to 75 to 85 is 20 years. To 90 is 25 years. To 93, that's a 28-year time frame. The problem is when we start to think that we can't handle that and need to go to short-term products, that's going to make your wife a greeter at Walmart on her 92nd birthday. We're going to be working all the way through because the only thing to keep up with inflation and taxes are good old-fashioned U.S. stocks. And a nice diversified portfolio can take the edge off of that with some fixed income and some international and maybe some annuities and some other things and real estate. We got some other way to diversify. But the goal today is to get everybody to do one thing. Because of all the media and all the nonsense and all the noise, everybody's flying their plane at like 2,000 feet above the ground. Now, anybody who's ever been down to Hartsfield realizes that no flights go from Hartsfield to Logan and Boston at 2,000 feet. At 2,000 feet, you're clipping trees and buildings, right? It's a very unsafe way to fly. Well, it's also kind of an unsafe way to look at your portfolio. What my goal today is I want to pull the plane back up to 30, 35, 37,000 feet, because that's pretty much where the safest place. That's when they say, okay, you can take off your seatbelt and go to the bathroom. We'll start the beverage service. That's when it's a little bit safer. And my goal with just a couple of slides in this presentation, we're not going to go through the whole book, don't worry. I just want to talk about A, getting back to basics, and then B, I'll close with an unbelievably powerful, true story that kind of reinforces those basics. And then the third leg of the stool is maybe we'll make some comments on what MFSC is coming down the pike in maybe stocks, bonds, and international. And I think that'll be landing the plane right at 12:30. So I was lucky enough to play 3 sports in high school and 2 sports in college, and actually played 2 in the spring of my high school career. I was baseball, and then I kind of got afraid of the ball, so I switched to tennis. So hockey in the winter, football in the fall, baseball until sophomore year, tennis junior and senior year. No matter what sport, and then I went to play hockey and tennis in Division III college. No matter what sport it was, if we went on a bad run, so you lose 2 football games in a row, you lose a couple of hockey games in a row, you lose a couple of baseball games in a row, or a couple of matches in tennis. Whenever you went on a bad run, every coach I ever had at both levels did some form of the following. All right, we got to get back to basics. So unfortunately in football, what did that mean? We're going to hit a lot. We're going to hit a lot on Monday, Tuesday, and Wednesday. Button up your chin strap. We're doing the Oklahoma drills, the Florida State drills. We are going to hit our way out of this funk. Not so great. Hockey was not as violent on the hitting, but it was, you're going to skate. You're going to get on the goal line and you're going to go, if any of you have seen Miracle, my favorite movie, blue line back, red line back, far blue line back, all the way down and back. That's called a Herbie after Herb Brooks, the coach of the '80 Olympic team. You are going to outwork and have better wind than your next opponent. You're going to almost like a punishment. Tennis is very similar. You get back to the baseline, do king of the court. Baseball, you get back in the cages if you're not hitting. You get back to basics. So I think we have done a great job in our industry of confusing the hell out of people. So I just want to confirm that we're back to basics. And the first one, as you can see here on the right, is allocate, diversify, and rebalance. Those are the 3 basics that I want to talk about. And asset allocation, very simple. How much in stocks, how much in bonds, how much in cash? That's where we need to be. And so when we look at those 3 things, stocks, bonds, and cash, we should have 2 things driving that. First of all, risk tolerance. Do you like roller coasters or not? But second, and probably more important, is when am I going to need this money? So even if you love roller coasters, but you need the money within 12 months, that should not be on a roller coaster. That should be in a boring, guaranteed, probably not making enough to survive, but also not losing any. What's a good example of that? My financial situation. So I'll tell you, I am 47 years old. I put away 15% of my pay. MFS puts away 15% of my pay. We've been doing that for 25 years. I'm not going to lie to you. It's a pretty big number. The asset allocation for that is 100% stocks, 80% domestic, 20% international. Why? I'm 47. I can't even touch it penalty free until I'm 60, 59 and a half. So round up, that's 13 years. Today's prices aren't my prices. I am flooring it. But I also own 3 CDs. What are those CDs for? Once I tell you what they're for, you're going to understand my point. The first one is for Lucy's tuition next year. The second one is for Nolan's tuition next year. And the third one is for Bridget's tuition next year. What is the most important part of all 3 of those sentences? Next year. So as much as I am a roller coaster loving, floor it wide open on my retirement plan, I still have some short-term needs that I got to make sure that I don't have the following conversation. Hey, Bridget, you loved your freshman and sophomore year at Blessed Trinity. You played 3 varsity sports, you softball state tournament, the whole deal. But I put your tuition in the MFS growth fund, and the 16 grand came back dressed up as $9,000 last year. So you're going to love Roswell High. I'm not prepared to have that conversation. I know that what I'm getting in the CD rate is about half of what inflation is. So not only am I not making money, I'm losing purchasing power. But I know that the number is the number that it's going to cost your junior year at Blessed Trinity, and that's more important to me. So we have short-term needs and we have long-term needs. We have, do you like roller coasters? Do you not like roller coasters? That's going to determine kind of the stocks, bonds, and cash allocation. But then we peel the onion one more layer and we go to diversification. And this is my favorite chart of all time. And there's actually really good timing here, because if you look on the right-hand side, so 14 through 22, you're going to see that international has a lot of red boxes kind of from the middle down. And what you're going to hear from every advisor is, oh, international has been an anchor, it's been a noose around our neck for the last 10 years. It hasn't done well. Very true, hasn't done as well. But look on the left-hand side. Man, starting in 2003, silver medal, silver medal, silver medal, silver medal, bronze medal, dead last, bronze medal, just off the platform, just off the platform. The 10 years before the last 10, you would have been in trouble without international. So we believe in diversification over the long haul. Can you take a snapshot on any one 12-month period and say, oh, that was garbage? Okay, yeah. But what did I say the best-selling asset class was last year? CDs. Look over the 2003 to 2022 period, which is summarized on that far right-hand side. What's the worst performing asset class? Oh, that's right, it's cash. So we still believe in having a diversified portfolio. And to prove it, I want you to look at the black box. Do you see the black box that kind of hovers down the middle? I want you to really focus on the black box because that diversified portfolio, let me explain what it is. You see all the other colors. You got the light blue, the red, the purpley blue, the other kind of teal. You got the turquoise, you got the real purple. You got all these different colors. So if you've ever been to Home Depot and you bought a gallon of paint, you find the color that you like, and what happens? They get a gallon of white, and they put it under the little machine there, and they put like 4 drops of different colors that, by the way, aren't the one you want. They blend it all together, and out comes the color you want. Well, I want you to think about that black box as that gallon of paint. So what the black box represents is an equal share of all the other colors poured into 1 gallon of paint. The 2 big takeaways for a diversified portfolio is, first of all, it never wins, never comes in first place. But far more important, it never comes in last. And to me, investors need a smooth, down the middle ride versus I'm in the far left lane going 80. I lock up the brakes, I go to the far right lane, and then I go to the middle lane, and then I'm at the far left lane, and then I'm going 80 again. People can't handle that. We've seen it. We've seen it when the going gets tough, investors run to CDs. So we don't want to make it tough. We want a nice, long, smooth ride. And that means you're going to own the winning horse every year and the losing horse every year and all the horses in between. And my argument is don't bet on one horse, bet on the whole race. Over time, you will be rewarded. And in the short run, you won't have the violent swings. And so that's why when we say get back to basics, how much in stocks, bonds, and cash? And when we get to those numbers, what kind of stocks and what kind of bonds do we want to have? Because having just one of those is not the best idea either. And then the last kind of return to basic is rebalance. And this is really powerful stuff. So if you look on the left-hand side, so when Mike calls you and says, hey, we have to have a rebalance talk, that's not a spam call. That's not a call that you don't take and you say, yeah, whatever, it's not that important. That's as important as the doctor saying, hey, you got to get in here. Something's off. That's like the dentist calling and say, hey, we just took some x-rays. We don't like what we see. You got to get in here. That's the same thing with rebalancing. And the proof is right here in the pudding. If you look on the left-hand side, you take a 50-50 stock bond portfolio. So you'd kind of like roller coasters, kind of not. You don't need the money for a long time. Let's just say you are 50-50. If you started that on January 1st of 2013 and you didn't touch it for almost a decade there, right? Look what happens to your portfolio if left untouched. The 50-50 is now 75-25 stocks. So if your risk tolerance says, I'm not roller coasters, I'm more teacups, and you don't touch it, by the end, you're on the Incredible Hulk roller coaster at Universal Studios doing the loop-de-loops, and that's not what you signed up for. So again, when it's time to rebalance, and when to rebalance is debatable. Is it quarterly? Is it semi-annually? Is it once a year? That's up to you. That's up to Mike. But if you're letting this thing run 3, 4, 5, 6 years without rebalancing, I can guarantee you that you are not in line with the original intentions of your risk tolerance. It may work. It actually may work for a while, but then you're over your skis in the riskier asset class heading into the rough market. Did we want to be 75% stocks last year? Maybe not. 50-50 would have turned out a little bit better. So quick recap on the basics. Allocate, diversify, rebalance. If you stick to those three things, you're going to be fine. I don't care who's in the White House. I don't care what the hell's going on in the Ukraine. I don't care what happened to Silicon Valley Bank. My mother always said, this too shall pass. And how do I know she was right? Because in 0102, I was 26 years old. I was a new wholesaler. I was living in Post Brookhaven. I didn't know whether to steal third or wind my watch. When people are saying the perimeter and all this stuff, I grew up in the city of Boston. I'm down here, the traffic, I don't know what's going on. And then we have Y2K 9/11 and the tech bubble burst. And I'm thinking one thought, I can still fly home, take the Boston police test, and I'll be fine. I put my 20 in, I get my pension. That was the only thing going through my mind. But I stuck it out. 03, 04, 05, 06, 07, great 5-year bull market. No one talks about that, but it was great. And then what happens? Starting in the fall of 07, right through to March of 09, the longest and worst bear market we have ever seen, right? Oh, you got to go back to like 1929 for the real worst one. None of us were investing then, so for us, that was the worst one. Stocks and bonds broke. You'll never refi again. The ATMs are 2 days away from spitting out dust. The whole thing is, it's malarkey. We're done. Well, did anybody think that on March 6th of 2009, we were at the very beginning of the longest bull market run in the history of our industry? Of course not. What was the best-selling asset class in April of 2009? CDs. It happens all the time. And so we go on a record bull market. COVID disrupts it. All right. But ironically, the market went down 34% in the spring. And I get it. This time it's different. It was pretty different, right? I'm picking up, Hauks and Alessios with a mask on in the parking lot. It was crazy town. But from down 34, what did the market end up at? Up 16. That's a 50-point run up that, guess what? Nobody got because they were in what? CDs. And so we have a great 2020 by the end. And then 22 happens and it was rough. The seesaw of stocks and bonds, it broke and both bums were in the dirt, and that hurts a little bit more. I get it. But at the end of the day, it was kind of supposed to happen. We had the average bull is about 4 years. We had like a 10-year one. We were in arrears and paying some back. It was as normal as a 6-4-3 double play. The problem is we went so long without getting punched in the face, people forgot what it felt like to get punched in the face. And so we have all this stuff going on, and everybody's conflating their political views and their economic views and their international relations views and their portfolio composition, and we put it in this one big blender, and what comes out is, I don't know if this is for me. Well, I would say it's probably the best time to be for you, because every time everyone's going into CDs, I know that it's the right time to get in. And so I fall under the Warren Buffett school of thought, which is you could take all of his books and all of his speeches and boil it down to one sentence. He says, I get scared when people get greedy, and I get greedy when people get scared. What does that really mean? He does the opposite of the average American investor. And how has that worked out for him? Pretty good. So those are the basics that we want to make sure that we're adhering to. And here's the story that kind of makes it all come together. So I want to introduce you to Margaret Reedy. This is a real life MFS investor, okay? If you look in the upper right-hand corner, this is Margaret's journey. She put 81,000 bucks through $250 a month over 27 years into a boring vanilla 60-40 fund. 60% large cap value, 40% high quality corporate bonds. As boring as you can be. Not a roller coaster, a teacup. And she didn't touch that money. If you look from 77 to 03, and that 81,000 bucks turned into 516 grand. Now, I could sit here and say, you should do what Margaret does. But our marketing folks are way more clever than that. They said, in order to drill home the point, what we need to do is create a second Margaret Reedy. For the sake of today's purposes, we'll call her maybe Chicken Little Margaret Reedy. And you see Chicken Little Margaret Reedy is represented in the green box. And I want you to focus on that green box and where it was born. So if I can make this a little bigger, you see right here in 1987, that green line was born. Now, why do we pick November 1st of 1987 to birth this fake Chicken Little Margaret Reedy? Well, I'll tell you the answer. Because October 19th of 1987, Black Monday, was the single worst day in the history of the stock market to date. Now, I'm going to tell you what the point drop was. I'll let you get your giggles out of the way, and then I'll put some context around it. So on that Monday, the market went down 500 points. Giggle, giggle. Why are we giggling? Because the market's probably gone up and down 500 points since I started this presentation. But you got to remember, that's 500 points off of a 32, 34, 36, 29, 32,000 point market. Back then, it was a lot smaller. So 500 was a much bigger percentage. If it's okay with you, a little poetic license, I'm going to use today's points to show you the size of the 87 drop. So instead of a 500 point drop, which it was, let's use today's impact. If the market went down 7,500 points today, would you get scared? You bet. You bet. Mike's phone would be melting on the cradle. The cell phone would be going off. The office line would be going off. The emails would be going crazy. 7,500 points in a day would send this place into a tailspin. That's what Black Monday really was from a percentage standpoint. So what we said was, what if, because of a 7,500 point drop, Margaret Reedy said, I'm out. This ain't for me. I can't do it. And she went to cash. Why do I say that? What was the biggest selling asset class last year? You got it, cash. So what happens to her 516,000? It comes back dressed up as 229 grand. Pretty much cut in half. All because of one bad day in the market, which, let's talk about 1987. How many news channels? Only 3, right? Were they more trusted back then? You bet. Were they as biased back then? Nope. And people would have been panicked. Today, I think people would run out of the market as fast as they could, as fast as they possibly could. So the moral of this story is, if you got a 20-year plan and you're in year 8, don't get out. Sticking with the roller coaster analogy, has anybody here ever been on a roller coaster? I'm going to say you're raising your hand. Has any of you guys ever got out during the middle of the ride? Of course not. Of course not. Instant death. Instant death. Getting out in the middle of a 20-year financial plan, you're not going to die, but you're going to kill your retirement lifestyle pretty close to that roller coaster jump. But what's interesting is if you look here from 7703, Margaret doesn't die in 03, she retires. So let's continue the journey. Good Margaret Reedy, as you can see in the lower left, and if I can make that bigger for those, she starts out with $546,000. We do a 5% withdrawal, because in retirement is when you take it out. We'll kick that up by 3% a year to keep up with inflation. Wouldn't have worked last year, but that's the national average over time. And that money, 546, spits out 648,000 in income. And when Margaret passes, her kids have $392,000 to cover the funeral. But if I tell you the good news, I got to tell you the bad news. That's good Margaret Reedy. Remember, Chicken Little Margaret Reedy didn't stick with the plan. She bailed because of Black Monday, so she's only starting with 220, not 540. That 220, if we apply the same 5% systematic withdrawal, kick it up by 3% a year to keep up with inflation, that 220 spits out 264 in income, And now her kids are wrestling in the parking lot of the funeral home over who's going to pay for it. If you look at this in its entirety, 6 plus 3, all right, that's 9, but then you got the 48. Okay, that's about a 1.1 and change million dollar outcome. 1.1 million off of 81 grand invested over 27 years spits out a total of a million plus. But Chicken Little Margaret Reedy ends up with 265 grand. So what that allows me to call this decision in 1987, and I'm rounding a little bit here, but that's almost $1 million mistake. And the reason why Mike had me on here is we spoke about this in January because he sees where the flows go and he hears the calls and the nerves and the panic and the this time it's different, which are the 4 worst words in our industry. And he said, hey, if you wouldn't mind coming on and telling that story, that'd be great. I'm not saying you all have 60 years left. I'm not saying you all have 30 years left. But the moral of the story is if we have a plan and we stick to it, we have a much better chance of having that living to and through and thriving in retirement versus it's down, this time it's different, I want to get out, lock in that loss, buy something that's guaranteed, even though the guaranteed rate is not even, sometimes 50% of what inflation was last year. So yes, you're not going to lose any money, but you're only going to be able to fill up half your gas tank. So I don't think that's a great trade either. And we really want to enforce the old tenets of investing. Allocate, diversify, rebalance, listen to the pilot, which is in this case is Mike Tarrant, and stick to the plan. I'll end where I started. I feel bad for you because we've made it so hard to do these simple things. We've made so many emotional decisions and we have terrible headlines every day. And there's so many things that we're all mixing and conflating and patchworking together. I'm not thrilled with us being in Ukraine. I'm not thrilled with inflation. I think interest rates are probably got one more 25 basis point pop and then they maybe start to drop or at least a pause. I have my beliefs on all of those things as an American voter, as a dad. I have my beliefs. But thankfully, because I've been in this business for 25 years, there is a Chinese wall, pun intended, between all my beliefs on election day and how I treat my portfolio. I haven't touched my retirement plan portfolio in 25 years. Haven't touched it. Ask me how much it's down last year. I have no idea because I don't look, because today's prices aren't my prices. The one benefit, well, there's more than one, but I think the biggest benefit of being on the inside of this industry is I am completely numb to all the nonsense. That's nothing to do with me. Now, you call me in 10 years, right? Now I'm 57. I'm 2 years away from, the red zone of taking the money out. Of course I'm going to take a look. Of course I may reallocate and add some fixed income and add some cash. Of course I'll change my asset allocation. Of course I'll change my diversification. The rebalancing is done automatically for me, so I don't have to worry about that. But the reality is I got the short-term money and stuff that can't go down. I get the long-term money and stuff that absolutely can go down, but I don't need it just yet. So I'm able to kind of hit the pillows and not really think about this stuff. Again, do I think about the international stuff on the countryside? Yeah. But the way that I try and kind of play the retirement plan is I just try and stay calm, cool, and invested. And anytime I get anywhere near the third rail of doing something like looking at it and getting nervous, I just try and remember Margaret Reedy. Black Monday was terrible. Last year wasn't good. 08 was terrible. 01, 02 was bad. 94 was bad. 72, 73, 74 was bad. I'm not saying there haven't been bad times, but the goods, they always outweigh the bads. And so if you can just have your timeline tight, your buckets of money kind of laid out, if the short-term stuff isn't involatile and the long-term stuff you don't need to touch, I think you have a really good chance of being successful in this business. So with that, those are my canned comments. It is 12:34, not too shabby on the timing. I know people said at 12:35 we have a hard out. I can stay and answer any questions or ask any questions, Mike, if you guys want to do that. But that's the calm, cool, and invested presentation.
Yeah, Greg, thank you very much. We actually do have extra time on Zoom today for those who can
Okay.
stay. Want to enter some Q&A in the chat, that'd be great. As you guys can tell, I'm not the radio host that Greg is. It would have been fun listening to both of us when we got to meet each other several years ago, 20 years ago, with his Boston accent and my Southern accent. And we were like, hey, what did you just say? But now we understand each other pretty well. So, Greg, thank you again for really this 30,000-foot level that I wanted to bring to our clients and attendees today. I know top of mind to everyone is just the banking issues right now in the economy, and I'm sure MFS has an opinion on that. And I'll caveat this with the way we invest in our portfolios, we tend to not be picking, timing, short-term trading, that sort of thing. Yet we do like to make strategic decisions. So we would like to know kind of a little bit about what MFS's take is on the current situation.
It's more the same. It's if you look at it, if it was a Texas bank with a Republican president and they were all oil and gas moguls and they were putting their company's money and they were commingling it with their personal money and they all got over their skis, it would probably be a gong show. But it's clean and it's tech and it's the current administration. At the end of the day, it's going to be a short-term news story. We had a little exposure in our small cap value fund. I think it was 10 basis points of the fund. It really reinforces the concept of diversification, though. So I think in our mid cap value fund, we have 111 holdings. One of them had a bad week. The other 110 will be okay. We don't think there's contagion here. This is not going to widespread come through the banking industry. It's not the big monster banks that are super regulated. And yeah, it's going to be kind of a headache for it's watch. I guess the good news with the constant news cycle is they're going to have to get something sexy in there soon, right? So this will be a thing and it'll come out and there's tools to fix it and you can make people whole and then people don't like that. But post '08, there are some rules where you can take assets that are underwater and use it as collateral so you don't have to sell it and they can come back to par and then we can kind of be clean of it. My MFS's stance is by Easter Sunday, we won't be talking about this. And again, it's easy to get caught up in stuff as they bash you over the head. And then each side now takes a position and then it becomes a political football and da 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 da. And we're saying our analysts look at the banks and we have banking analysts all over the world. And we had exposure to, I think it was First Republic for 10 basis points in one of our funds. And that's, 550 billion under management. So it's literally like the lint between the couch cushions. But the big takeaway that you need to have here is this is not some domino that we think is going to destroy the banking system. Does it, we'll wait and see on the Fed, but this will be a non-event by Easter Sunday. And it's people are going to try and make it the biggest headline in the history of the world. The problem is our news media has just become a cry wolf scenario. If everything is doom and gloom and if everything is the end of the world, well, then nothing's the end of the world. And I think, over time, markets have proven that to be the case.
It reminds me of the old Incredibles movie. If everybody is a superhero, then nobody is. Kind of a scenario there. Your comment earlier about the availability of information, I think is so true, how it exacerbates panic and fear. And my primary concern always in a financial planning environment is just the potential for life-altering financial decisions related to today's media. So I would just throw out there for anyone who ever has questions about what's going on in the current world of finance and the economy, just always call us, throw us an email, whatever. We're happy to answer those questions along the way. And just really looking back, Greg, what you mentioned earlier, just the basics, of blocking and tackling in a portfolio, of allocating, diversifying, rebalancing. That's really the approach we've tried to take, is to put buckets in a portfolio of short-term, mid-term, long-term type money, manage distributions accordingly, kind of based on where things appear to be, and really just make sure we line up the money with the time horizon. It's very important to do that. we tend to believe in the current environment, just continue to gravitate a little bit more toward higher quality type companies with great dividend streams, that sort of thing. And I've really attempted to build the portfolios that way. So really just appreciate your comments on that today. With
No,
that said, I
listen,
want to go ahead.
no, I mean, there's only two devils in investing. I mean, literally,
Mhm.
it's, I'm not going to say it's easy, but I am going to make the case that it's simple. It's not that complex. If you don't touch it while it's on sale, you're going to you're going to do better than 80% of the investors in the world. So it's, if you have 100 grand and it's worth 82 one day, don't touch it. If you can just do that. Now the real good ones are going to add when it's at 82, but even if you don't want to add, if you just don't sell. But the other true devil is what you just touched on. It's the misalignment of goals slash needs and product. So I told you I have 3 big tuition bills next year. They are in a short-term product. So they are perfectly aligned. Can't make a ton, can't lose any. Long-term goals, retirement, long-term products. I don't even own a bond in there. Flooring it. The problem is this. I got a long-term need. I'm going to put it in a CD. Or I want to buy a boat Memorial Day weekend. I got it in the MFS Growth Fund. If you misalign those two things, you're going to hit the side of a mountain. That's not even a debate. But if you keep your alignment and you don't touch it when it's on sale, you're going to make it. You're going to make it. Because let's say you're 63 and you're thinking of retirement, but hopefully Mike's got a couple of years cash already out of the market, right? So it's not like, oh, I'm retiring. Let's say you retire during a bear market. All right, it's bad luck. But hopefully you're not like, I got to take it all out today. Hopefully I've already got 2 years sitting in a CD. I got a year under the bed. I got a year in a CD. I got the 3-year, 4-year money in like muni bonds, which, yeah, they went down last year, but that doesn't happen very often. It's probably the best entry point in tax-free bonds in the history of the asset class. Just a little plug there. But if you already have that, a bear market will never get you. Because the only true bear to swipe and rip your head off is when you touch it when it's on sale. If you can just avoid that and keep your time horizon and products aligned, you're going to be fine. Now, I said it's not complex. That's simple, right? 2 things. But it ain't easy, because if it was easy, everybody'd be doing it.
Right.
It's hard. It's hard to do. And it's not complex to do, but it is hard to do. And hopefully between Mike and events like this, you just get, hey, that's a good confirmation. I was thinking that, but I wasn't sure. Stuff like this hopefully can help you avoid those unfortunate decisions, which unfortunately happened all of last year and continue to happen, but that's okay.
Absolutely. Greg, really appreciate that. Just want to be, mindful of everyone's time today. Again, just thank you all for attending. If you have any questions, please feel free to, call us, email us. We're happy to help. Any other resources Greg can bring our way, we'll be able to happy to provide those for everyone as well. We're looking to probably roll out another webinar in April, and based on our client survey, likely going to be a financial planning related topic. So watch your emails for that. And based on preferred times of respondents, we might be running an 8 a.m. and a 12 p.m. session. So just watch your email more for that. Greg, again, thank you for your partnership with us. Thank you for all you do to help support our practice as well, and your company, MFS. We greatly appreciate it. Everyone, thank you again for your time today. Take care.
See you, Mike.